After listening to The One Up on Wall Street on Spotify by Peter Lynch, here's everything I learned from it so that you can learn it too. Little rundown about me if you're new here. I'm Maxwell Coconis Michael. I'm an aspiring equity investor and I do equity research, and I'm building my public track record on this channel and my other social medias, as well as building my research firm. All of that is in my bio description, all of that. Let's get right into it. So, the main idea, concept, I would say, the most important at least, that Peter Lynch teaches in The One Up on Wall Street is about using your knowledge through your life, your career, your just personal experiences, and what you see out throughout the world or on social media and what have you, to get an edge that the average investor can, or rather average professional cannot. The average analyst looks at financials, reads 10Ks, and gets the idea of a company from the buy side of investing and from their professional tools and whatnot. They have a lot of advantages, such as technology, resources, etc. But you, the average individual investor, have an advantage over them by being able to use what you know in your own life through your passions and your career to get an advantage. So let me give you an example. If you're a doctor, let's say, and a new drug is on the market, and you have been giving more prescriptions or whatever, and because of your 10, 15 years of schooling, however long you got to go to school to be a doctor, you have an advantage because you know whether it's going to work, whether it's not, or at least you have a insider edge, not insider trading, but an insider edge on this drug, Ozempic, is becoming more popular. So let me see if it's publicly traded. Let me see. Now let me get it. This is my second point. Let me see. Just because something's becoming more popular, a new product or whatever, I have to see if it can actually affect the company's top and bottom line. So I'll give you an example of what wouldn't work. Let's say Apple starts selling some new fancy case. It's transparent, it'll never go yellow, right? Apple makes this much revenue each year and this much profit. They could sell a this let's say $20. They could sell this $20 case for 20% of their iPhones. Excuse me. Do you think that's affecting their top and bottom line numbers? I don't think so. So, in the same vein as with my drug example, you're a doctor and you have an insider edge on this new drug becoming successful before an analyst and the institutional investors pick up on it. If it's Pfizer, which makes this much revenue and profit, I'm assuming it's publicly traded. Okay, I'll give an example, whatever company it is, right? And they're making $50 billion profit a year, and this drug is a miracle drug, but for 0.005% of the population can even get it, and how like half of them may buy it, right? And the drug costs this much to make, and they can only charge this much, right? Let's say $50. Like, that's not going to affect the top and bottom line numbers for Pfizer. It's not going to affect, it's not going to, it could be super popular, all this marketing, all this revenue being made in this specific unit of the company. But for the overall giant that it is, it's not going to make any meaningful percentage points in earnings. It's not. Now let's take a different example. A smaller company, Rocket Lab. I don't want to look it up all right now. All of my numbers will be put up on screen when I'm editing this. But let's say a smaller company like Rocket Lab, right? And they're making this much in earnings, revenue, and profit. And they just made their biggest rocket, cheaper than ever. They just started on this new, not automatic. They started this new factory, and they're pumping out one a week, right? All of you reusable. That is most definitely going to affect their top line revenue and their earnings. That is, I guarantee that will affect it. They just did it one. They're doing once a week, and it's not Starship big, but it's also not. I think they call it Neutron. Well, for whatever their smallest rocket is called, but it's not that small either. So it's in the middle, right? And they're getting once a week or once a month, let's say. That is going to affect their earnings. And if you're in the even as a if you're deeply passionate about it, not necessarily your career, but if you're in the rocketry, rocket science, private rocket company space, and you have an edge on this, then that is the type of information that will help it. Now, that's not a perfect example, right? Because an analyst would be able to see that too. But it's that type of information. If you're a carpenter, or if you're a florist, or if you're a doctor, as I said, even a police officer, whatever your career is, or your passion, your deep passion, not like I'm interested in, can't think of an example, right? Let's say boxing. I'm interested in boxing, right? I am personally. I think it's pretty cool. I don't know that much about it, and even if I did, how much profit can I really get from that? What in the stock market? I don't know. Probably not that much. So even so, I might just be like, it's not that stuff that you're a little bit interested in. I'm talking either your career, which you do on the almost daily, or a passion, which you might do almost daily, or you're studying, learning, doing whatever it may be. So I'm talking about that type of stuff. That's where you can get an edge. So that's the core idea. Using what you know to get an edge on Wall Street. Now, I'm going to get into something. We probably have a lot of aspiring professional investors here, or current professional investors watching this video. You can still get that same type of edge, even though your career is just investing. Like, it's not a specific industry besides that. You can still get an edge by applying the same principles of being passionate and looking outside the box, and not just looking at straight numbers, to get an advantage over your average analyst. So everything I just said, whether you're aspiring to be professional or you're a professional, and especially if you're not, you're just an individual amateur investor, amateur not determining your skill, but your whether it being a career or not. So that's the core idea, using what you know to get an advantage over Wall Street. Now I'm going to get into a couple more things. If you can leave the video now if that's all you're looking for, right? But a couple more things Peter Lynch taught me through this book. There are 6 types of companies he talks about. I have to look here. Slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. A slow grower is a big company, maybe slightly outpacing the not the S&P, slightly outpacing the economy in terms of earnings growth, but they're not a new company, which is another one. The fast growers like Rocket Lab, Kraken Robotics, insert 20 company names here, right? They're not fast growing. They're not fast grower growing 25-30% per year. They're growing maybe 5, let's say, yeah, 5% per year, outpacing the economy, but not that. They're not going to grow fast. I don't know why I'm rambling. Anyway, stalwarts are big companies, huge companies that can give you a hedge in a recession due to their importance, their brand power, their moat, but they are also not growing at any significant amount. They probably pay dividends like Coca-Cola. Turnarounds are possibly cyclical companies. I guess cyclicals are companies that go up and down with typically possibly macro. inputs, the economy that are determining it, but also just whatever the industry there is. Every, let's say, 2 5 years, they have a down period, and then same for the up period, like cars, for example, automotive companies. So turnarounds can be cyclicals, they can be any of these companies listed so far, but they are companies that for whatever reason you think they're down, either stock price or earnings are down temporarily for a specific catalyst that caused that, but you know through your research or through your personal edge that they are going to turn around. A example of this would be, I guess, I guess, pause. An example of this would be if Amazon, for example, had a failure of a product, they spent a bunch of money on it, but their core business is still doing well, and they're going to be able to turn around. It's a bad example. It's a bad example. Cut that out. What the fuck am I talking about? Ugh. Hold up. Oh, yes. Okay. Action. An example of a turnaround, sorry, I had to look it up. I was brain farting crazy. Would be Apple in the 90s. As you may or may not know, close to bankruptcy. And before Steve Jobs came back, if you didn't know, Steve Jobs had left, had got kicked out, all that. Started Pixar. Anyway, he came back and slowly turned the company around. They were near bankruptcy due to multiple reasons. They were able to turn around. Eventually, the main thing that actually turned around was the iPod, and then later the iPhone. And then after Steve Jobs passed, Tim Cook made it into what it is today. So that would be an example of a turnaround. It's self-explanatory. They turned around. They were down and they went back up for whether it was a management change, whether it was a economy change, new technology, whatever it may be. And the final one is an asset play. That could be something like a fast food chain that has a super low PE, like no one's buying it, no one's giving it high multiples, and you look at all the real estate they own and say, oh, not only do they own this real estate in fast growing communities, but they own the real estate. The real estate itself is worth more than what the company is being valued at right now. So that would be an example of an asset play. It doesn't have to be real estate, it can be hard goods like coffee beans, it could be technology, which is a great example because of how much they advance now. But GPUs, stuff like that, actual assets that are more valuable than the what the company is being valued at. You have to be careful though with asset plays because even though on the balance sheet the assets may show this, if you really look at it, the what you're able to get for them may be super low. So like Berkshire Hathaway, you Warren Buffett may have thought that, oh, I could turn this around, sell the, what are those called? Looms? Yeah. You could sell the looms for $200 each, but in the actual real life, in actual real life, you could not sell it for $200 each. You may have been able to get $25 each for them. So you have to be careful with asset plays in that sense. It's not always what is shown on the balance sheet, what you can get in reality. So there's six type of companies. I'm gonna say it one more time: slow growers, stalwarts, fast growers, cyclicals, turnarounds, asset plays. So that is our second. That is the second thing, main thing Peter Lynch taught me. A couple things to end off with on valuing companies and when things to know when you're investing, making your investments is one, earnings are king. A company's valuation will eventually, over months, years, decades, will match up to what the company's actually earning. So when you're in the market, look for those type of discrepancies, whether good or bad, when making your investment decisions, and know that the valuation will eventually reflect earnings. A couple stock picking rules to add with that. I don't really like saying stock picking, but I guess investment rules. No, even though you should know if it's a revolutionary or influential product, don't go for trending niches. Your neighbors are saying buy this, buy that. Your cousin, your brother, your dad, mom, they're saying buy this, buy that because something's trending right now and they have 350 P's. So the trending niches are something to be worried about or to be wary of. Don't be, but be wary of that when the valuations are not reflective of what the industry's actually worth. The what because it could be trending and it could actually have some merit, the industry, whatever it may be, but if they're so detached from future, not even current, what future earnings or what you think future earnings are going to be wary of that. And one of the main things Peter Lynch warns to be wary of is diversification. When a company has so much cash, or they they're earning so much, or they're just bored, they don't have much room left to grow, and they start diversifying, which is when they diversify into different industries, different product lines, start acquiring different companies with the guise of diversification, but in reality they're diversifying because they're spreading themselves thin, excuse me, and they're not proficient in these industries, so they're just spending money acquiring companies, starting new product lines just to do it. Not no proper plan in place, and it's not actually benefiting the bottom line. One last thing before I say the final point: don't water your weeds, which means you don't cut your flowers, which are your winning companies. Don't sell your winning companies just because they've given great returns, and don't keep your losing companies just because they've gone down however much. And that's going to explain in my final point, which is stick to your principles. So every single principle I just laid out about your passions and careers, about each type of company and what to do in each of them, about earnings, and about diversification, trending niches, and not watering your weeds, is all sticking to your principles. Don't sell something because it's successful if your original thesis is still playing out and is still the reality at hand. And don't sell a company if your original thesis is still playing out and you believe is still going to continue to play out right now just because the stock price is going down. If you want to learn more about that type of stuff, subscribe, like, comment, all of that. But subscribe because I'm going to make a video once I finish it this week on the Intelligent Investor, Mr. Market, which gets way more into the sticking to your principles type of thing. And I'll be able to explain that all to you. If you're interested in my journey, first of all, thank you for getting to this point in the video. Second of all, if you're interested in my journey, that's what the channel is really about. Sorry, recording, documenting my journey, being an aspiring equity investor and entrepreneur, and teaching and connecting with other people, my peers along the way. So yeah, subscribe. All my contacts, information, other social media type of stuff are in the description. So yeah, it's been Maxwell, Kilcones Michael. Peace.